SMB Investor with Nick Bryant and Sean Smith.
Hey everybody, I've got Sean Smith, managing partner at Search Fund Ventures, and today I'm joined by Jason Ehrlich of Fruition Capital.
Hey, Sean.
Jason, would love to kind of tee off with you giving a background to everyone here so they can get a better sense for how you got into the space, what excites you about it, and then we can chat through some of our topics.
Yeah, sure. So my firm, Fruition Capital, pretty much focuses on the self-funded search space. My own background has been in a couple of parts to get me here. I sort of had my professional journey and my investor journey. My professional journey has been all business, right? Some corporate roles. I went to business school, was in management consulting. After that, some strategy roles. But maybe a decade or so I got very interested in alts in general. And so started investing as an LP just selfishly to diversify myself. And initially that started in commercial real estate, but it wound up branching into lots of different asset classes. And I became a deal and a fund sponsor in the commercial real estate space. And maybe 4 years or so ago, I got really clued into what was happening in the lower middle market and with search and SMB and all this that we know about. And it just really excited me. I saw a huge opportunity, specifically in the self-funded search space, where the equity ecosystem was very immature. The self-funded search side just had tremendous opportunity for players like what you and I have built to come in and try to be a little bit more of a sophisticated partner for some of these entrepreneurs. And we'll talk about the actual opportunity in SMB and why we both love it so much. But we saw a space that was really ripe for us to come in and participate, and that's what we do now.
And you guys were one of the earlier kind of institutional funds in the space, I would say. And how long ago was that when you kind of first started investing in SMBs?
Yeah, I mean, with Fruition, it's been about 3 years. And, I think most of the space is occupied by individual folks that like to invest, 25K to 100K in a couple of deals a year. And so we said, let us come in, professionalize it a little bit, because what our model is, we will come in as an anchor investor. We're almost always the largest equity check on the cap table. We're taking a board seat to stay involved with our searcher entrepreneur partners, not just from an oversight and governance perspective, but also to help them and be sort of an advisory and guidance type partner as well.
Sure. And you guys, did you kind of shift it all from a size standpoint? When you started out, were you doing smaller deals, smaller checks? And I know you're currently in kind of a new fundraise at the moment. So maybe talk a little about some of that for us.
Yeah, our first fund was a little bit smaller just because we were new in the space and we weren't quite sure exactly how much deal flow we would realistically be able to create. So we only focus on B2B companies. We really look at the $1 to $3 million EBITDA space. We won't touch things that are cyclical in nature, that are highly tech centric. So we'll do some B2B services, some manufacturing, some distribution, but it's a fairly narrow, lens in that anything consumer facing is out. All the home services that are very popular in this space are out, and deals smaller than $1 million are out. So our fund one, we were writing checks in the 600 to 800K range, and we put 8 portfolio companies in the first fund. We are at a fund two now, as you say, a little bit larger, not vastly. Our typical check now is $1 million. The deal sizes are roughly the same. We'll look at some slightly larger deals. Certainly we don't go south of $1 million. But I would say in general, the thesis, the strategy has remained the same with, minor movement upward in fund two.
And so as you think about kind of what you learned in fund one, track record you've built, now kind of taking those learnings and augmenting them with your strategy in fund two, what originally got you excited about the space, and what excites you now?
Man, it's largely the same. I mean, the reason we went with fund two and we went bigger in fund two is that the thesis that it was a thesis at the beginning, it has largely played out in fund two. I would say certainly there have been learnings, and we've rolled those into our approach for fund two. For example, we were only focused on acquisition capital, right? We're coming in and we're capitalizing a change of ownership transaction. Well, we wound up doing 2 deals where the searcher had actually already acquired their initial platform, maybe a year before, 2 years before, and now they were going to go and gobble up a larger player. And they needed to sort of re-equitize. They weren't able to use their balance sheet for that. They've proven that they can already acquire and successfully operate a business. In one of the cases, they'd already done a little tuck-in already, so they could also show some integration chops. So we didn't envision ourselves as, providing a growth equity, quote unquote, but that's actually a space where it was a search deal and they're growing via M&A. We love that profile. I think it's de-risked significantly. So, that's something that has become part of our thesis that wasn't there before. Similar, we accidentally had some deal flow find us from Canada and from the UK without looking for it. And we turned those deals down in Fund 1 just because we weren't set up for it, but they were appealing deals, some better valuations than we saw here, attractive investor terms. And we kind of did our research and said, hey, tax treaties are favorable. If we get one of these things that's right down the fairway, that's north of the border, no reason for us not to do that deal. And so little tweaks like that. But I think writ large, the things that got us excited about this in the first place, very, very attractive entry valuations, stable businesses with a cash flow profile, a business model that we can wrap our heads around, and customers that we can, point at as reliable year after year. All those things have been true. And particularly, our thesis is really wrapped around stability, right? If these businesses continue doing what they've been doing for years and years and years, we as investors will do well. Well, there's always this sort of not underwritten upside case where many of these guys are looking to do a roll up, or they're buying a platform and they're looking to bolt it on, because if you're buying 1 to 3 million EBITDA, right? If you get it to 4, 5, 6, now you're having an exit with a significantly expanded multiple, whether it's to an independent sponsor or to a PE firm. And we don't bank on that, right? But half of our Fund 1 portfolio, only a couple of years into that portfolio, is already set up for those sort of expanded multiple type exits because they've run an M&A strategy. And it's not every company, but we're not looking for that in every company, right? So, but I think that watching that play out sort of in real time, even though we haven't exited yet, we can look at a company that's done 4 acquisitions and look at their top and bottom line earnings and say, whenever we are ready to exit this thing, unless we really hit the skids before then, it's going to be a very lucrative exit. So it's been fun to watch that play out.
Yeah, that's great. The upside case that you don't necessarily underwrite against is a big part of our process as well. It's kind of to look for that asymmetric bet in a sense.
Yeah.
Right? Other kind of areas we've thought about for that, upside case could be a tech enablement approach where you can introduce either a much better software stack or workflow automation, or potentially even something more meaningful. Curious if there's any other kind of, outside of the roll up, and I know you guys typically don't focus as much on, software driven strategies or things of that nature, but are there any other kind of, big swing type strategies outside of a roll up that you've seen?
I mean, it's one off, right? And it's very contingent on the business. We love the whole low hanging fruit thesis here. Many times we're talking about a baby boomer who's running this business getting ready to retire. And oftentimes they've held it longer than perhaps they should have, in that, their energy and their attention may have been on their health or their family or whatever for years. They may not have been reinvesting in new product development, sales, marketing, personnel, even whatever it is. So, we invested in a manufacturing outfit that was running at something like 40% utilization on a single shift. So, huge opportunity to vastly increase the bottom line without a bunch of CapEx by simply creating a website, investing in some outbound sales, which had been purely inbound for years, and then take it to a second shift, take it to a third shift. There are opportunities like that abound, and it's not everything is just a low utilization play. But there are plenty of opportunities where you just see the foot off the gas in various places. And sure, another one that we looked at, the core of the business, what really drives it is scheduling optimization. And they were doing it on a legal pad. You know what I mean? And there's plenty of modern tech-enabled workflow, software packages that do that, right? And so the opportunity is, hey, we're going to come in here and we realistically think, even without moving top line, there's a significant opportunity to pull more down to the bottom line through optimization using some more automated tools. And again, our thesis is not tech-centric. We're never going to invest in a software platform or something whose delivery is really wrapped tightly around a tech product. It just moves too fast. It's too volatile. It sort of violates that whole stable, enduringly profitable profile we're after. But with that said, there's huge opportunity to put in tools within the business, whether it's related to operations or marketing, to modernize that and drive efficiencies. And we're all about that.
Yep. Yeah, in virtually every teaser you see, there's some mention of, introducing sales and marketing, or introducing some type of software to reduce the amount of activity that's on pen and paper. We've seen in certain cases, both with, searchers we've talked to and within our portfolio, that identifying kind of the software strategy, identifying those kind of points of efficiency that you can kind of create post-close, aren't actually as challenging as the change management efforts themselves. Because to your original point, right, you've got folks who have been at these companies for quite some time. They've had, systems and ways of working with the other folks of the company that, whether or not they're efficient, they've gotten used to them. So now coming in and saying, hey, we're going to upgrade to this cloud-based ERP, and rather than, punching your stuff into your Excel sheet and sending it over email, you're going to have it all synced up in the cloud. That can be real shocking for some folks. So how have you kind of navigated some of those change management things alongside your portfolio company? I think that's a great one for folks to think about.
It's a great point. And it comes back to that I mentioned about how we're an anchor investor and we like to be sort of an advisory partner to our entrepreneurs. We've seen a whole bunch of these transitions, and we've seen them go well and we've seen them go not well. And so that's something that we always counsel about. And I think the sort of core principle is don't break it. You know what I mean? When we're coming in, most of these businesses have never changed hands before. Some of them may have sold once 30 years ago, but oftentimes it's the first time there's ever a change of ownership transaction. So sexy new ERP system and all, new workflow automation tools, blah, blah, blah. That's multiple months down the road, right? We are always advising our entrepreneur operating partners to get in there, spend 30 days changing nothing at all, build relationships with the employees, with the customers, with the suppliers, jot everything down. Every time you notice a problem in the process, an optimization opportunity, low-hanging fruit, a custom, whatever it is, make a list, keep it all, but it's don't do anything at the beginning. And then we slowly start to drip change in a prioritized way. And I think that some of those, optimization, the tech changes, they come behind some other things that need to happen first to sort of get people comfortable with the entrepreneur, build that trust, and start to say, okay, we're going to start making changes. They're going to come gradual at first, and it's all about building that confidence that, hey, what we're doing is going to be ultimately good for you. We've got your best interests at heart, right? And then by the time you're a quarter or two down the line, now you've got some trust, you've got some footing in the business. Now you can start implementing, one at a time, some of those larger changes with less risk of disruption.
Yep. Yeah, that's, I think, spot on, right? First things first is get in there, build the relationships, establish that, this isn't a shakedown like people see in Wall
Private
Street.
equity.
You're not where you go,
Right.
So that's the foundation. Then you've got some behavior or more kind of, cultural shifts that are gradual before just dropping in some brand new way of doing things. It makes a lot of sense.
Yeah.
I think one thing we've thought about, with one of our portfolio companies where we sit on the board is how can you put the right incentive structures in place to start changing behavior so that when you introduce the technology, it's actually it's a really positive thing because it's a force multiplier on that incentive structure that people have already started getting used to. So it's kind of, like you said, very gradual ways and very positive ways to kind of influence that behavior change rather than force it.
Yeah, agreed.
So why don't we talk a little about, just on the point of the transition and culture. I was we were speaking with an investor the other day, and he had a great line. He said, "There's kind of two schools of thought in the space," and I think largely this has proven true in a lot of deals I see. There's kind of a very experienced operator who's maybe mid-career executive, has P&L leadership experience in an industry that they're acquiring. Maybe the business is a bit more sophisticated, a bit larger, but you really believe that operator can execute because they have a strong track record. The other school of thought is, back someone who's pretty new to the space, but very entrepreneurial, has a good business acumen, and is buying a super simple business that just doesn't require a ton of, complex operational headache like capital budgeting or what have you. So what do you guys find yourself skewing one way or the other when you're looking at sponsors and searchers, or is there, kind of a world for both within Fruition?
Yeah, there is. And really we think of it in three buckets. What you're talking about in my mind is almost the distinction between self-funded searcher and independent sponsor. In fund one, we only talk to self-funded searchers. In fund two, we are looking at some smaller independent sponsor deals there. The rationale being, if in self-funded searchers are generically in the $1 to $3 million EBITDA segment, from 3, 4, 5 million EBITDA, you start to run into independent sponsors. Sometimes those deals have fairly similar entry economics as you're getting in some of those smaller businesses. And to your point, you get a more experienced operator. Oftentimes you get a lower leverage point. There can be a lot to like about those deals. And so we will look at them. I think that our expectations of an independent sponsor and their deal are completely different. We absolutely expect longer track record, likely more industry experience in that particular vertical that they're operating in. When we're talking about a self-funded searcher, almost always we're talking about first-time CEO. But maybe 10% of them have bought a business, sold it, they're going back in again, love that profile. But most of the time we're talking about first-time CEO. So yes, simple business model matters a lot. We're looking to those entrepreneurs to have experience in the critical skill sets of an owner operator. So you haven't done it before, but have you led and managed teams of people before? Have you had some P&L responsibility? Have you been in sales, run a sales function? Have you held operational roles? We're generally not backing entrepreneurs that are coming out of, just an investment. They've been in an investment bank and they've seen a lot of transactions, but they've never been in any sort of operational or sales type roles. That's not really the profile of the entrepreneur that we look for. Those are kind of two of the buckets. There is bucket three, which is we do look at light manufacturing and some value-added distribution type businesses, which can be more technical in nature. And so for those businesses, you have to absolutely have someone who has an engineering background, who has worked in manufacturing, in their career. I can't say I don't think we would never invest in an entrepreneur with a pure business background who is coming into a manufacturer. So just to put a point on that, right? Anytime we're looking at a technical business, manufacturing in particular, we're really going to look for an entrepreneur that has that engineering and manufacturing experience. Whereas in other business models they require less of that technical expertise, a more of a generalist business background or somebody who has experience in an industry that's not the industry that they're going into is more acceptable. And again, it's a very much a case by case evaluation.
It makes good sense. And I think especially as you look to deploy larger checks, I would have to imagine, the larger deals are often coming from folks that have probably a little more of a track record, right? And probably aren't using an SBA loan to finance the deal, for example. Tell me if
We,
that's a
yeah,
fair
I mean,
assumption.
we definitely still see SBA loans very prominently in our portfolio. I think most entrepreneurs, when they first come into the space, they sort of understand, oh, it's a $5 million cap on my SBA loan. Well, there's a number of SBA lenders that will do pari passu loans on top of that. You can get up to a seven, sometimes an $8 million debt stack with what is essentially proxying an SBA loan. So I love the SBA product. I think, you know, from an investor's perspective, having an entrepreneur who is signing a personal guarantee on that loan, who is all in the business, it just creates the best alignment of incentive that you can possibly have. Because yeah, they have huge, an economic upside. They probably retain like a, excuse me, a 60% economic ownership in the thing when it's done. So if they run their playbook well, it's a lifetime, wealth creation event for them. But the other side is, that's carrot. You also want stick. Having them personally guarantee that loan is no entrepreneur is quote unquote handing back the keys, as you would in like real estate. They're tethered to that thing, and the SBA is a big part of that. So yes, we see more experienced entrepreneurs and sponsors because we look at the larger deals, and they tend to look at the larger deals too. SBA is definitely still an important part of our portfolio, and probably half, I would say, of the deals are SBA deals versus using like an SBIC type loan or something else.
Got it. Very interesting. Um, you mentioned earlier that you guys typically look for, well, you certainly always look for the dynamics of enduring profitability. You mentioned kind of, B2B focus. What are other kind of key characteristics of a company that you look for?
Yeah, B2B is the core of it. Really, that goes directly along with that is we want to see a diversified base of customers that have been buying year after year after year. So diversified means we don't have any huge customer concentration. It's not like your top account is going to be 20 or 30, 40% of sales, right? We want to see a well-mixed customer base. We want to see long tenure, and we want to see low churn. So we're not necessarily requiring that these customers have contractually reoccurring revenue, but they come back year after year after year. And beyond that, it's not an RFP based, competitive quote based situation. They're more or less buying from you on a PO, if not a contractual type basis. So the customer dynamic has a ton to do with it. Again, the business model has a lot to do with it. We're always looking for these, air quotes, old economy type businesses, but we want to see a simple business model where we can quickly wrap our heads around why has it been profitable for so long? And do we believe that those forces are going to continue? So, certain businesses develop little natural geographic monopolies. I think about we have two heavy commercial towing businesses in our portfolio, and they develop little geographic monopolies, and that's why they're so profitable over the long term. There's others where you can point to this critical spot they've built in the value chain of their clients where they're providing some very important part or service that's not a huge part of their customers' cost structure. So there's very low incentive for their customers to say, I'm going to try to bid this out. I'm going to try to disintermediate you. They're just happy with what's been delivered, and it's hard to disintermediate. They'll do it over and over again. I think that looking at the competitive dynamics matters a lot too. We're not trying to go into any industries that are, call them red ocean industries where it's just very mature, highly competitive. The barriers to entry have a lot to do with that, right? If we're looking at agency type businesses, for example, staffing, marketing, all you need is a few people and a computer, and you go in there. If you lose your sales rainmaker or you lose your key account manager, those businesses evaporate, right? And so we stay away from those sorts of dynamics. So enduringly profitable. We also look for track record. So, at least 10 years with stable type performance. We're not looking for something that's a new business. We're not looking for something that's on a growth rocket ship or is in a distressed turnaround kind of situation. These are the ones that have been chugging along, doing the same thing for a long time.
Got it. And so, in every deal, ideally the company's going to exhibit most of those dynamics, but there's always going to be a few of them that, are yellow flags, right? I think, most frequently when we see deals, it's things like customer concentration is frequently, higher than we'd like. Um, Earnings is frequently, at a peak in many cases, right, versus prior years. So how do you guys mitigate some of that stuff, or what do you look to do to either help the searcher mitigate things, or what do you look for in now transitioning to the deal structure of the acquisition, um, to kind of mitigate some of those challenges?
Yeah, well, what's built into your point is that certain things implicitly are just deal killers, right? And it results in us just passing. We pass on the vast majority of deals that we look at, right? Our funnel is pretty tall. There are some that, to your point, can be identified and planned around and wherever possible, structurally mitigated. I mean, my absolute favorite tool for that is the forgivable seller note, because I'm not a huge fan of seller rollover equity unless it's an independent sponsor situation where they're actually going to be remaining on board and continue to operate the business in the go forward management structure. If you have a seller who's retiring coming out, you don't really want to be partners with them in a rolled equity situation. I think that just creates awkward future marriage moments. But having seller skin in the game via a note, 100% of the time. What a lot of people fail to negotiate is automatic offsets against that note. So if we're coming into a business and that top client is 15%, maybe even a little bit north of that, or you've got a situation where nobody's over 10, but your top 5 customers are all 10. So, you've got some decent concentration right there in your top tier, even though it's not just one customer. In those kind of dynamics, we want to see provisions in the operating agreement from the outset that say, hey, your payment either of the note in full or of some portion of the note is contingent on this customer remaining a customer for the next 3 years, at or above the historical level of purchases that they've made. And if that changes, that note disappears, or part of that note disappears depending on the size of it. And, in that way, you still don't want to see that key client account disappear, but you are in essence lowering your entry price, to compensate for the fact that you bought a business that didn't have that customer as a part of it. So that, structurally, if we see those sorts of provisions in there, can get us comfortable with that sort of, as you say, yellow flag.
Yep. Yeah, definitely, tying deferred consideration dollar for dollar to
Yeah.
the risk that you've identified is probably, the best way to mitigate those sorts of things. Other ways we've seen that, whether or not you call it a mitigation approach or kind of just getting started early, we like when sponsors start kind of, prodding the team to develop a backlog, or kind of start making steps towards a value creation strategy during the deal process. Not
Yeah.
only is that great to kind of just start, de-risking the transition, it's also a good way for them to start building a working relationship alongside those folks, in a less kind of contentious format, right?
Yeah,
So,
that makes sense. I think, we definitely see a dynamic, especially with the retiring seller situation, which is the most common one, where the foot will get taken off the gas as it relates to the sales pipeline coming into the close. And so that's something that we do, again, counsel our entrepreneurs to spend more time on, is doing whatever they can to make sure that doesn't change. And also, making sure that it's not just that we have financials from the month before close, but like sales pipeline reports and things. We want to see a current view. If it's tailing off, we need to know that right away, because that's very much going to influence what day one on the ground looks like. It might be, hey, there's this huge operational efficiency play, but guess what? If your sales started tailing off at day -5, what you're going to do on your first day is going to change,
yep, absolutely. Well, why don't we kind of circle up to our last topic here, which is investor terms. And I think you guys are so well positioned to talk about this because you look at both kind of the self-funded search deal structures and the independent sponsor deal structures. We do the same. And I've talked about this quite a bit, but would love to get your guys' take on you know, whether, what aspects of each structure are preferable. I know you mentioned, seeing a personal guarantee in that SBA loan structure is great, but that comes with substantially higher ownership for the searcher, which is a great carrot. On the flip side, with independent sponsors, there's a typical kind of carry management fee, transaction fee structure. So how would you, if you were to line the two deal structures up and do your best to compare them apples to apples, how would you think about the benefits and drawbacks to each?
Yeah. I think if I just had to pick one, I prefer the independent sponsor economics. Can talk about why, but to go through it point by point. So self-funded search deal versus independent sponsor deal. So they're both going to have a preferred return or pref, right? The self-funded search deals almost always have a pref that's higher than the independent sponsor deals. So with independent sponsor deals, we're looking for like 8 to 10, let's say. Self-funded search deals, we pretty much want to see 10 to 15. So that's a material difference in, and again, the pref is 100% of cash comes to investors before the entrepreneur would get anything with that. With the self-funded search structure, it's a liquidation preference behind that. So we get all of our capital back plus the pref before the entrepreneur gets any upside. In the independent sponsored deal, basically they're set up with hurdles that are performance based on the back end. And so if the business only winds up doing 2 times or 2.5 times MOIC, their split of the final proceeds might be 15%. And if it gets to 3 times MOIC, then their split goes to 20%. 4 times MOIC goes up from there. So what I love about the independent sponsor structure is that it is so explicitly tied to performance, how much of the pie that they get. With self-funded search, yes, we get our money out, all of it, before they get anything. And yes, we get our pref. But after that, it flips over to a pro rata split, right? And oftentimes, like you're saying, the entrepreneur could be retaining 60, 65%, or, in rare cases, up to 70% of the economic ownership. And so that's regardless of how the business winds up performing from there. And again, big carrot for them, big stick with the SBA guarantee if they fail. Most often in an independent sponsor segment, you're not looking at a personal guarantee on the debt. So they do have, this alignment of incentive in that their upside is directly tied to their performance. But, in a scenario where the business is really just floundering and it's becoming clear that it's never going to do what they thought they were going to do, I think they have less incentive to really get in there and grind and try to maximize it, because at that point, they're not going to have much upside, right? They're going to have their 5% of EBITDA management fee that they're getting, which, the proxy to that in self-funded search is the self-funded searcher is the everyday CEO. So they're paying themselves a salary to sit in that seat and run the business, which is right. So, again, end of day, I think I love independent sponsor structure having that direct tie to performance, but self-funded searcher has vastly more incentive to make sure that the thing doesn't go bad. And if it starts to go bad, to really just work the butt off.
Yeah, there's a personal level of, incentive in there for the
That's
self-funded searcher.
Mm-hmm.
And, the other kind of unspoken thing I think is, the self-funded search career path is kind of what you touched on earlier, almost a career CEO, if you will, of small businesses, or potentially after that, investing and kind of removing yourself from the business that you bought. The independent sponsor path is typically, at least from what I've seen, most folks want to go kind of raise their own PE fund eventually, right? And become more of a portfolio type investor rather than a kind of single business investor. So those kind of long-term goals also have a pretty significant impact on how people operate the business that you and I would be investing in.
Yeah, that's spot on. Independent sponsors, unless they're brand new and it's their first portco, they'll usually have portfolios between 2 and 6. And they're not in a fund, right? So they're called fundless sponsors, but it's the same sort of thing. They're acting like a PE fund. They've got a portfolio where they have to manage all these things. It just happened that they raise them one by one, and they're not as a true portfolio. for the investor. They are for the independent sponsor. But I completely agree with that. What you get with the independent sponsor is someone who virtually always will have significantly more experience. They will most typically have a team as well, and they are chairman of the board, so to speak, for each of those individual businesses, but they are never, I don't want to say never, but very, very rarely are they the day-to-day CEO operator. And that's sort of a key distinguishing point between the two models.
Yep. There's a third model that you and I don't invest in, but it's the traditional search model. And what's interesting to kind of think about is the independent sponsor structure, which typically the carry hurdles that you kind of talked about, range from 10% at the low end up to 30, maybe 40% at the high end, depending on, the experience of the sponsor and how high those, either IRR or multiple of invested capital hurdles are. That structure in principle is not too far off from where traditional search typically nets out for the traditional searcher. And what you also see with independent sponsors is usually kind of more structured governance. Now, I know when you guys invest in a self-funded search deal, you have kind of a floor level of governance that you need to see. But just for the more general investor group out there, you're usually going to see more structured governance with independent sponsor deals than self-funded search deals. So the parallel I'm kind of trying to draw here, as you might see, is that independent sponsor deals are almost kind of inching closer to that traditional search type structure that people have gotten really used to, and that it's pretty well defined without the funding the search process and the diligence costs, right?
Yeah, I mean, I sort of see two key differentiators between those two models. I think your point about the ultimate upside for the sponsor or the searcher is similar in that, in traditional search, if all goes well, that searcher receives like 20-25% of the upside. And, it can be in that range for independent sponsor based on performance. Agreed on that point. To your point, for folks who aren't totally deep in the space, in the traditional search fund model, the part of it that I like least, because I'm risk averse, the reason I don't like venture, there's a stat out there that a little more than half of searches fail. Entrepreneur goes out there, spends 2 years looking and just doesn't find a satisfactory business to buy, or finds a few and has broken deals, but never closes one and gets across the line. So those search funds are paying those folks salary for 2 years to do that. They cover, I think there's an average of 2 broken deals for every one that closes. So they're taking a lot of zeros on the front end. And you have that 2-year horizon where that cash is going out. That you're that much further away from having cash flow from the operations of the business coming in. So the combination of the upfront zeros, and the risk that comes with that, and the deferred cash flow, I don't love that. I would much rather hit doubles with everything and have my capital go right at the time of close and have no broken deal risk, no failed search risk. Yes, we have a smaller piece of the pie, but we shouldn't really ever be striking out. The other key differentiator in my mind is control. To your point, more sophisticated governance in independent sponsor deals by default. Yes, we're a little bit of an outlier because as the anchor, we're always redlining the operating agreement, putting in quite a bit of that in self-funded search too. But in a traditional search fund, the search fund has control. I mean, capital C. The searcher is a hired CEO, and that searcher can be fired almost at any time for almost any reason by the entrepreneur, or by the investors rather. And so certainly you don't have that in self-funded search, and very, very rarely would you have something of that nature in independent sponsor land. That independent sponsor really has control and plenty of things for, fraud, negligence, all of that. But writ large, they're in control of that deal, whereas truly the investors are in the control seat in traditional search.
Very good. Well, Jason, anything else you want to kind of end off with here? I think that's everything we had to talk about.
Yeah, no, I appreciate you having me on. Hopefully this has been informative for the folks watching. Again, our firm is Fruition Capital. We operate in a very similar space to Sean and the SFV team. We're investing out of Fund 2 now, which is up and running. We're about 4 months into our second fund, targeting a portfolio of 20 companies.
Awesome. Jason Ehrlich, everyone.
Thanks,
Thanks
Sean.
so much. Take it easy.